Good afternoon, ladies and gentlemen, and welcome to the weekly precious metals and commodities commentary from us here down OANDA, Singapore. I'm Jeff Alley, Senior Market Analyst here. It's been a pretty exciting night overnight. Everything has been led by energy, in particular crude oil, in particular Brent crude, which raced higher by some 3% overnight, dragging WTI with it. Lots of reasons for that, but it's had a big feed through into the commodities markets, particularly the base metals, where iron ore, the London fix yesterday, was up a gigantic 5.8%. Zinc, lead all moved higher, as did most other base metals. And of course, precious metals were also dragged higher. We'll come back to crude in a minute. Let's just start with gold. And as we can see in front of us, gold has had a bit of a sideways week still, if I just blow this up a little bit. But we can see yesterday in particular that we had this gigantic sort of $12 rally up to the 1282 region, breaking the red line here, the 100-day moving average in the process, having broken it the day before and indeed closing above it. So what does this tell us? Well, I think to a certain extent the Saudi Arabia purges, as they're describing them in the mainstream media, have had played their part with a bit of safe haven action. Obviously, with energy moving higher, even in the face of a stronger dollar, that sort of dragged gold rather reluctantly kicking and screaming higher with it. But as we can see in Asia today, it's just been a red line straight back down. And this is the thing with these geopolitical events. We've found in particularly precious metals this year that their effect tends to be transitory. And I suspect that the pressure will increase on the downside again on gold once this situation in Saudi Arabia settles down. Having said that, gold has held this short-term support line, this green line here, quite successfully over the course of late October, early November. That line today comes in at around 1266, which would be the first support. And then we have the 200-day moving average, which would be our second support. That's at 1262. And then, of course, this key 1260 area. You know that in my previous commentaries, I've said that the market is still very long on the speculative side on the futures exchange, on COMEX. I suspect that this may well be the pain level where a lot of those structural longs head to the exit door. So this is this region here between the 200 and this 1260 line is the definite must-hold region. When we look on the top side, we can see a little bit of resistance from late last week at around 1285, and then we have this big daily double top here at the 1291 sort of 60 region, followed by 1296, which I feel is a bit of a marginal not line now before we head up to the sort of the 1315 region. This looks like it will be hard work though, and we're probably going to need, more of a structural change in the US dollar in order to see gold manage to sustain a rally of any note. That said, if we squeeze the chart up and have a look at the Fibonacci's and the bigger picture of things, despite all the noise, gold does seem to be in a consolidation range over the past couple of months. If we go back here to the left-hand side of the chart, we can see it seems to be sitting between its 38.2 and 61.8% Fibonacci retraces, and they are at 1263 and 1299. So lots of noise, but perhaps not as much as everybody thinks. Popping over to silver, which has actually traded more constructively, as I said, over the past recent times. Certainly more constructively than gold. We can see this long-term support line rising up from bottom left to top right. It's held numerous times. That's almost a test and hold. We've held 3 times here. It too got dragged higher by the energy rise yesterday, but we've not really managed to take out this resistance at 729.50, this sort of double top here. In fact, we failed just ahead of it. We crawled up through this blue line, this 200-day moving average, but as you can see in Asia, we've headed straight back down again as profit taking is settled in and in reality bites. This support here, this red line at the 100-day moving average at 16.88 though, hasn't done too bad a job of holding back the sell-offs over the last week or so. So we do seem to be stuck between the 100 and the 200-day moving average at the moment. This support line today comes in at 16.775-ish, 16.75. And this is followed by this set of multiple daily lows at 16.5380. And then, of course, this is what I call our must-hold line, which is at 16.3270. And after that, as you can see, we open up a lot of clear air. Having said that, actually, silver has traded, as I said, more constructively than gold. And so until this trend line here is broken, I'm not going to get too bearish. I rather think that, a bit like gold, despite all the noise, we are in a bit of a giant range trade, as we have been when you look back all the way to the beginning of September. Platinum. Again, despite all the noise, going back to sort of early September, mid-September, we have been in a bit of a range, and that's been denoted by around the 946 region and the 904 region. And it is a big range, I will give you that, some $50. We can see yesterday that we were dragged higher again as per gold and silver. Again, the same sort of pattern has occurred though, hasn't it? Yeah, we've given back half of those gains so far, and it's just showing you really how the safe haven premium in precious metals really has sort of dissolved actually over the course of the last 6 to 12 months, and how the effects of it tend to be transitory. We could probably pop another horizontal line in here now. It looks like a pretty solid top has formed now. If we look at this in platinum, we'll call that 1, 2, 3, 4, 5 with a little blip here. That's 5 highs now we have around the 936.50 area. Your own charts will be able to give it exactly, but certainly I think around 936.50. This level must be respected now on platinum, simply because over the last month, this level has stopped every single rally. Above there, we have the 100-day moving average. Then we have a little congestion around 946, and then the 200-day moving average around the sort of 953 region. So actually, platinum does have a lot of wood to chop on the resistance side, on the top side, for any meaningful rally to be sustained. And I suspect that it may drift lower before we see any rally. So the worst could still be to come here. Looking at the chart, we have a little support here at this late November, 27th of November low, which is at around 911. Then this 903.85, and then of course this is the must hold. Support line around 890. No support or resistance really. Signals being given by the RSI at the moment. Palladium, on the other hand, has loved this rally over the past evening, and because of its dual industrial precious metal nature, it has held on to its gains. If we take a look at the longer term line, we can just see how strong this rally continues to be. This line dating all the way back to October last year has held every dip. This line, this uptrend line, is still way away around the 868.6 mark today. If we blow this chart up a bit so we can get a bit more detail and drag this down, we are at record highs now. We can see that we rallied yesterday some sort of $12, and we have given some of that back today. But when you look at it in the bigger picture, we are still solidly in a technical uptrend. Key support 947, which is a good $50 away. I guess my only worry here, if we were to put a little horizontal line up here, I was looking at this earlier on today, we can count 1, 2, 3, 4 highs. Now I can tell you for nothing that these highs all sit between 1006 and 1009. You could almost count this little beastie here, which was 1002. We have topped now a number of times over the last few months above $1,000. So I think although Palladium still looks massively bullish in the longer term, it is indeed struggling above 1,000 for now, although I do note a series of higher lows here. We really do need to see this top crack, and we really probably need to see a close above 1,020 before the bullish freight train starts again there. Otherwise, I guess it could be setting itself up for a bit of a correction, and that could technically run all the way back down to this 947 level. Having said that, even at 947, it would still solidly be here in an uptrend. Take a look at copper. Copper yesterday had a very good day, rallying some sort of 5-6 cents a pound, as we call it, based on the US futures. Very, very good day indeed. It has again seen profit taking in Asia, but as you can see, we are seeing a series of higher lows dating all the way back to early October. Generally, the world economy seems to be firing on all cylinders at the moment. Chinese data is good. Stock markets are high. Confidence is very high. And confidence is very high in the world growth outlook. In fact, I haven't seen so much bright things written about the world economy for probably a good 10 years. I don't know if that means we should be nervous or not, but nevertheless, the picture in front of us today is of a fairly positive chart. The first support, if I just pop this down, will be around this 305.50 region. And then actually we have a slightly ascending line coming through on the top side here. So we do have some short-term resistance now that will come in at the day's highs at around this 315 level. After that, we move up to what would effectively be a double top. I just put the horizontal line up, and that comes in around that 322 area, plus this overnight, this island high at 324. So 305.50 on the downside, sort of 315 on the top side, 322. If we squish the chart up though, we can actually see the longer term resistance line, which I've only comes into play once I squish all the time scale up. The key level, without making this chart almost unreadable, is this 3.3 region, and we can see when I compress the chart that is the series of highs way back here in May 2014. But for all intents and purposes, it does look like copper is getting ready to retest that level, which will be a bit of a game changer, I feel, once we finally get there. Natural gas. For once, I have something actually to say about natural gas, which no doubt you'll be very excited to hear. Well, it was dragged much, much higher overnight by the oil rally as WTI approached 57, Brent crude approaches 54, natural gas rallied some 3.5%, and as we can see today, it's rallied again, continuing off where it started from its New York close, and it's rallied through the overnight highs at 3.03. Probably the biggest move we've seen in a very, very long time in natural gas. Part of the reason will be that as oil gets more expensive, then gas becomes more appealing as a substitute for oil and power plants and lots of other petrochemical processes, etc., as oil gets more expensive, because gas, as we know, has been fairly well offered for a very, very, very long time. Having said that, despite the fact that we have had a spectacular 3 sessions, we are still in this giant range denoted by the 275.40 area and the 3.1070 area. So we still haven't broken out of this long-term range. What I can say though is that we have broken back above the 100 and the 200-day moving averages, and it would be a very bullish sign from a technical perspective if we were to have a few more daily closes above these levels. Also, if we look at the bottom, the RSI is not overbought, so that would be more good news for long-suffering natural gas fans. Let's get to really what has been the big news of the week so far. We all know about Saudi Arabia We also have to take into account, actually, potential supply disruptions in Iraqi Kurdistan, Libya, Nigeria, where the rebels have threatened to start a rather bloody campaign after a long truce. And last but not least, something that has been off the radar, it seems, Venezuela. Venezuela has been desperately trying to restructure its debts. I suspect it's going to have absolutely no luck doing that. And they're also having trouble actually producing export-grade oil for overseas refineries, and their oil production has been slowly but surely coming down. They do seem to be in the last death throes before a long overdue and awaited default happens. This could take quite a lot of supply out of the market. Probably more pertinent to WTI, but certainly something to keep your eyes on in the news. Geopolitical concerns have definitely been responsible for most of this rally, I think, over the last few days. We have got up to the heady heights of around 64.8 today in Asia. That would be initial resistance. I would say 65. And we can see down here we have a triple bottom, and it comes in at around 60.10, and that's the first major support. Second support will be this horizontal line here at 59.1 or 59.1. But really, I think the important support after that sort of previous 60 triple bottom, which I think is actually, let me draw this line on. 1, 2, 3, very important. This line here, though, the ascending trend line, which comes in around 58.7. I think things might get ugly if we were to break down through that. I will draw viewers' attention to a little bugbear that I've been batting on about for the last week, and this is the relative strength index. And as we can see now, I've highlighted it here, it is now at extremely overbought levels. This has been a fantastic indicator over the last 12 months, 18 months of impending reversals and or corrections in the market, whether they be short squeezes or long squeezes. So I would urge perhaps a bit of caution if you are still extremely long up here, because the RSI tends to win in the end. That's been my experience. Although geopolitical tensions may drive this, the longer it drives it, the uglier the correction could be. Having said that, I haven't turned bearish on oil. We can still move all the way down to this trend line here, way down at 56.5 before we start getting nervous. But the faster it goes up, potentially the uglier the correction could be coming down. And we do have both of the crude inventory numbers coming out tonight and tomorrow night to negotiate. Let's go to WTI. Another spectacular night for the much maligned WTI. And as we can see here, I need to squish this chart up. We've got this nice little ascending trend line here. We've just had one little false dip through it. And that's actually held all the dips here since the beginning of October. This one comes in today at around the 53.13 area, miles and miles away from present levels at 57.25. We can see here that WTI has been trying to break through this 57.5 high overnight. Then we do have some interim support around 54.5, followed by this 52.5 region. It's hard to say here what will happen with WTI. Clearly, there's been a lot of hot money going into it. Clearly, it's benefiting from the possibility of a default from Venezuela. A lot of Venezuela's oil gets sent to US refineries, and US refineries are designed to process and handle Venezuela's heavy crude. I think the most important thing, if we come to the bottom of the chart, though, is yet again this RSI, the relative strength index, and we can see how overbought this is. Yes, the chart looks bullish. Yes, constructively, it does look like OPEC is making progress, and oil can track higher into the new year. Geopolitics aside, we have a booming global economy, oil consumption, yada, yada, yada. We had the Baker Hughes rig count fall over the weekend as well. So all those are combining, but that doesn't mean that we can't have corrections on the way, and this RSI is usually a very good warning of it. So I can't pick the exact time it will happen, but I can tell you that the longer it goes up like this, so fast, the uglier the correction could be when it comes back down. If we come back to reality though, right now, as I climb down off my soapbox. From a technical point of view, there really isn't a lot of resistance now between where we are and 61. Now, if I squash this chart up, and I have to squash it up quite a bit and let it fill in. If we come over to the left, we can see this big area of congestion here. We're back in early 2015, and that is between sort of 57 and, of course, 61. We are in the zone now, so oil will probably have to do a bit of wood chopping to make progress to the top side, but this is the next big congestion zone, long-term resistance zone. So it'll be interesting to see how WTI manages to make progress through there. Bear in mind, if we were to have a big overshoot in crude inventories, that may be the precursor to what would be probably a healthy correction in a pretty rampantly bullish market. Well, after all of that, let's move along now to the soft commodities. Probably the more boring of the sets today, actually, to be honest. One thing is that the soft commodities have not really enjoyed coattailing the move up in precious metals, base metals, and commodities. But we are seeing some interesting progress here. If we look at corn, it's still gaining some sort of support from the fact that ethanol has suddenly come back into focus, and I think ethanol will come more and more back into focus as oil keeps moving higher, because again, like natural gas, it can be a substitute. Bit of a marginal trend line. What I'm trying to show you is that we are having a series of higher lows as we move to the top of what has been a very long-term trading range between 3.3 and 3.48. So we do seem to be slowly but surely moving towards the top of this range, but it's pretty hard to get excited about corn yet until we actually see a break of either this level here at 348 or a break on the downside of 3.3. Soybeans, on the other hand, we're showing some interest as well. Again, this can be used in ethanol. I've jiggled the chart around today, and I've actually extended this upward facing trend line support, and it is very interesting. I think it's now a very, very solid line. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, almost 11, 12 times this line now has held pullbacks in the beans since sort of beginning of August. And I think if this turns into a bit of a triangle formation, then if we look at the base of the triangle, I worked this out earlier on, the target for a breakout now of this triangle would be around about the 10.4 region. So to me, from a technical perspective, soybeans are still looking constructive. We're well above the 100-day moving average. We're well above the 200-day moving average. We're holding above the support at 973. And it does look like another triangle has formed after this other large triangle, albeit on a smaller scale, but it's still slowly but surely moving upwards. I think soybeans probably look the most constructive of the softs, and it's definitely worth keeping an eye on. Let's pop over to sugar. Really, probably the most boring chart you're going to see this week. Apparently, short sugar positions have been reduced on the commodity futures in the United States. But clearly, although we have seen a rally along with most commodities in the last couple of days, we're really not seeing anything, any sort of sea change. The only thing I can derive out of this is that we have tested and held the 100-day moving average 1, 2, 3 times. And as I said last week, I think it's a bit of a pivot. So when it actually finally moves above it, it moves a fair distance. When it moves below it, it moves a fair distance. And it's sort of like an intraday pivot line at the moment. So the 100-day moving average is at 1375 today. If we were to move down through that, we would probably see a drop down towards 1300. Otherwise, we are still solidly locked in our long-term range of 15 and 12 and a half. And finally, over to wheat. And again, Not really a lot to be told here, to be honest. I mean, we do have a series of higher lows yet again, but when we look at this chart, I think it's reflecting the fact that there are a lot of shorts, a lot of sellers around on the wheat futures in the States. We do have what I would say would be a marginal double bottom down here now at 403.80. But really, when we look at this chart, I'm seeing still solidly in a 4.39, 3.93 longer term range, going back all the way to late August. I'm seeing that we still have not tested again the 200-day moving average, and I see that the 100-day moving average, this red line, is actually also now at the resistance level of 4.39, meaning this takes on an even more significant connotation. So this particular resistance line looks like it will be very, very hard work to break, as does the support. So really not a lot to see out here. If you're trading wheat, you're probably going to find more action on some of the other commodities. Well, that's it today. I hope you've enjoyed it, and I wish you an exciting week ahead and a very profitable trading. Thanks for listening in and watching, and goodbye.